What is going on, everybody? Welcome back to yet another video. So in today's video, I'm going to be starting a brand new series called Introduction to Day Trading. I'm going to be dropping a brand new video every single week, maybe even twice a week. And then I'm also going to be starting a series called Introduction to Swing Trading. So pretty much both of these series are going to be a free training course just for you guys here on YouTube. So if you guys do want more videos, what I need you to do right now is make sure to click that like button, comment down below, letting me know that you guys want more videos, because if you don't, I'm not going to make them. But while you're at it, if you are new to the channel, make sure to click that subscribe button to see these future videos. But yeah, let's hop right into it. So before we hop into this presentation, first off, if you did not know, I do have a 450-page book on Amazon titled The New Age of Technical Analysis, where I go further in depth on my overall strategy that I will not be covering in these free day trading classes as well as the swing trading classes. So again, if you guys do want to check out my book, The New Age of Technical Analysis, the link will be down in the description. Anyway, so hopping into today's introduction to day trading part 1, we are going to start very basic, and we are slowly going to start building on top of it as the weeks go on. But starting off, what is day trading? Day trading involves actively buying and selling securities within the same day, trying to capitalize on short-term changes in price. You can day trade in many markets: the options market, which is ideally what I do, equity market. I also trade in the Forex market, crypto market, bond market, commodity market, futures market. There's so many different markets that you can trade in. And when picking which market to trade in, honestly, it comes down to personal preference. I know a lot of people that prefer trading futures. I know people who prefer trading oil futures, and I actually know people who prefer trading bonds. So it really comes down to what is your personal preference. So before you start day trading, make sure to do some research on all of these different markets, and you can pick from there. But since I am mainly an options trader, that's what this whole course is going to be involving. So diving into options. In the options market, excuse that little mistype right there, we have what is known as option contracts. So in the options market, what we have is calls and we have puts. Calls are what you buy when you think a stock price is going to go up in price. So say we're looking at Tesla, and through our technical analysis, we think Tesla is going to go up in price. We would want to be looking to buy calls. Now, on the flip side, if we thought that a stock price was going to drop, like let's just say that we think Apple is going to drop in price doing our technical analysis, we would want to look for puts. So you buy puts when you think the stock price is going to go down. So again, calls and puts, which is nice because we can profit from both ways in the market. So here's an example of SPY. So looking at our technical analysis, and again, I cover setups like this in my book right here, but looking at the overall setup on SPY, it's clearly above the moving averages. It looks really bullish. Therefore, because it looks bullish, ideally we want to look for calls to the upside, and we're going to be able to profit as SPY continues to go up. Now, in this example, SPY ended up looking very weak. We can see that it pushed up in price and then immediately rejected, came back down below the moving averages, which is bearish. And then from there, it ended up flushing to the downside. As a result, looking at the price action and seeing, okay, SPY is looking very weak, we could end up buying puts and we could profit from SPY dropping down in price. So now also in the options market, again, when you're buying calls or puts, there's something known as the Greeks, and this is in every single contract that you can purchase. So the contract, it's an agreement between me and the seller that this stock price is going to be at this price by this expiration date. And again, we're going to cover on that here in a little bit. But inside of those option contracts, we have the Greeks. The very first one is known as delta. So delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security. So say we're looking at an option contract, it costs us $100 to buy that contract, and we have a delta of $20. If the stock price were to go up $1, we are going to profit $20 on our contract. However, if it were to drop $1, we would lose $20 on our contract. So again, the delta is letting us know how much we are going to make or lose for every $1 the underlying asset goes up or down. And then next up, we have gamma. So the gamma represents the rate of change between an option's delta and the underlying asset price. So when you're looking at gamma, this is letting you know how much your delta is going to increase or decrease for that $1 move in the underlying asset. So again, let's just say that we buy a contract for $100. We have a $20 delta and a $2 gamma. what's going to happen is if the stock price goes up $1, we are going to make the delta. So that $20, we profited $20. But now because the gamma is $2, the next dollar that the stock goes in our favor, we're actually going to make $22 on top of that original 20. Now the next dollar goes up after that. We're going to make 24 on top of the original 22 on top of the original 20. So what is that? That would be a $66 gain for a $3 move. Now from there, the delta is just going to keep on increasing in those $2 increments. So it would go 24, 26, 28, 30, 32, etc. And eventually the delta is going to max out at 99. It does not go higher than $99. And then the next Greek is known as theta. So as a day trader, theta doesn't really matter because we don't hold our contracts overnight. If you're trading 0 DTE, the theta is going to work against you pretty much every minute throughout the day, but I don't really trade 0 DTE. So theta refers to the rate of decline in the value of an option over time. If all other variables are constant, an option will lose value as time draws closer to its maturity, so the expiration date. Theta, usually expressed as a negative number for long positions, indicates how much the option's value would decline every day up to maturity. So if we were to buy a contract for $200 and it has a $40 theta and the stock price does not move, so going into the end of the day, let's just say that SPY were to close at 400. If SPY opens up at 400 tomorrow, we are going to lose the theta on the contract. So immediately going into tomorrow, the option contract is going to be less than what it was yesterday when you bought it. Now let's just say that SPY did not move all day, stayed the same exact price. Going into the next day, the theta is actually going to be higher because again, as it gets closer to that expiration date, the theta is going to slowly start increasing, and then come expiration, it's more than likely going to be worthless unless it's in the money. So again, theta is letting you know how much your contract is going to depreciate every single day that you hold on to it. Now, the next one is going to be Vega. As a day trader, this is kind of hard to measure when we're actively day trading, but Vega measures the amount of increase or decrease in an option premium based on a 1% change in implied volatility. Implied volatility is basically the market maker's expectations on the stock price going into the expiration date. So if there's very high expectations like around earnings season, or this week we have FOMC, the market is going to be very volatile. And as a result, that's going to make the option contracts a lot more expensive because the implied volatility is up. So since that IV is jumping up in price, if we were to look at the Vega is telling us how much the option contract is going to increase or decrease for every 1% change in the implied volatility. So you'll see it. If you go to the option chain of Apple today and you look at the implied volatility versus how much the contracts are trading at the money, and then look the day after earnings, you're going to notice a significant difference in the option price. So now, expiration dates. So typically heavily traded stocks have an expiration date every Friday, unless Friday is a holiday, in which the case the expiration will be on Thursday. But stocks like Apple, Microsoft, Tesla, Nvidia, AMD, so on and so forth, they have expiration dates every single Friday because those are heavily traded stocks. So as day traders, we always day trade the very first expiration. Today's Monday. If I were to be day trading Tesla, I'll be trading Friday's expiration. On Wednesday, I'll be trading Friday's expiration. Thursday, I'll be trading Friday's expiration. So yeah, as day traders, it is always that very first expiration date. Now, heading on over to heavily traded ETFs such as SPY and QQQ, they actually now have expiration dates every single day. They used to not. It used to only be Monday, Wednesday, and Friday. I personally do not trade 0 DTE. It's very rare that I do. So again, today is Monday. I ended up trading Wednesday's expiration. Tomorrow's going to be Tuesday. I'll trade Wednesday's expiration. Come Wednesday, I'll trade Friday's expiration. Thursday, I'll trade Friday's expiration. And then on Friday, I'll trade Monday's expiration. And then come Monday, the cycle repeats every single week. So in a future video in this course, I will be showing you how to master SPY and QQQ. So again, if you guys do want that, make sure to like the video, comment down below, and make sure you guys are subscribed. Now, as far as brokers, I will be doing a video in this course on how to set up ThinkorSwim. But good brokers do not use Robinhood. You are not going to be able to actively day trade using Robinhood, especially if you want to make this sustainable across the long term, because Robinhood is not good for day trading. So good brokers. My personal preference is going to be ThinkorSwim and Interactive Brokers. If you're in the United States, highly suggest ThinkorSwim. Just personally, with ThinkorSwim, you get everything in one broker. So you get your charts, your indicators, unlimited amount of indicators, things like TradingView and I believe TrendSpider. There's an extra charge, or no, TradingView, you have to pay more if you want the extra indicators, and then TrendSpider, you have to pay just to use the charting platform. So ThinkorSwim, you get the charts, you get the indicators, you get the execution, you get the level 2, you get the time and sales, you get the active trader, and the list goes on. So if you're in the United States, highly suggest ThinkorSwim. Again, I will be making a video on how to set everything up for that. If you're looking for a platform just for execution purposes, you could use Tastyworks. That is a platform that I used to use. If you're outside the United States, I highly suggest Interactive Brokers. I will be leaving a link down in the description for that one if you do want to check out Interactive Brokers. You could also use something like Webull. I know a lot of people use Webull. I personally don't. And then you have stuff like Questrade and TradeStation. I've never used either of them, but I do know that they are reliable brokers. Now, when day trading and setting up your account, you can choose between a cash account and a margin account. This depends on what kind of trader you are. I always say to go for the cash account, especially if you're somebody not starting with $25,000. Reason being, if you go with a margin account, you're going to have the PDT rule, which is you can only make 3 day trades a week. But if you're a cash account, you get unlimited day trades per week. So as we can see over here, margin account can use margin to buy more shares than cash in the account, which that's a double-edged sword right there, especially if you're a newer trader. Definitely don't do that. You can short sell stocks. Again, newer trader, definitely don't be doing that. Subject to PDT, again, 3 trades per week. You can lose more money than is in the account. Again, definitely don't want to do that. I only use a margin account for swing trading. So again, that's something we'll touch in the swing trading course. Subject to margin call is definitely not something you want to get. Must have 25,000 a day trade if labeled a PDT pattern day trader. PDTs are eligible for day trading buying power up to 4 times. Again, I highly suggest do not do a margin account. Now, cash account can only trade with the available cash in the account, cannot short sell stocks, subject to free riding rules, can only lose the cash that you're trading with, and subject to cash settlement. So with a cash account, let's just say that you only have $10,000 in your account. You use $5,000 today and you make $1,000 profit. You cannot use that $5,000 plus the $1,000 that you profited until the next day. So yes, if you are a day trader, I highly suggest the cash account. That is the way to go. But that is going to wrap up part 1 of this free day trading course. Again, if you guys do want more videos like this, make sure to comment down below, like the video. Let's get rich together. Make sure you guys are subscribed. And other than that, I'll see you guys in the next video.